Are you tired of waking up every morning to see minus 10, minus 20% on your portfolio? Do you miss the bull run when making money was so easy? Are you just lost and don't know what to do with the current market conditions? Well, my friend, all you need to do today is sit back and relax, and I will tell you exactly what you need to do during this bear market. Alright, so in this video, I'm going to give you clear steps that you can follow, and those will help you come out on top of this bear market. If you put all of these into motion, you will be ahead of 95% of the people in the crypto space. So let's get right into it with our step number 1, dollar cost averaging. Now, I'm pretty sure you've already heard this somewhere else, and it might sound a little cliche and easy, but it's for good reason that everyone advises dollar cost averaging. It is seen as quite an effective strategy even during a bull market, but it is especially true during a bear market. The reason for this is that everything is in a downtrend during a bear market, and for that reason, if you invest at very random times and not keep investing consistently, then you're gonna have moments when you'll have put a lot of money and there's gonna be a short-term dip afterwards that's gonna make you lose a big portion of that money. If instead you divide that big portion of money into several recurring buys, then your total portfolio won't be affected as much by that dip. As a quick example, let's say you have $1,000 to invest. If you invest them right now and the crypto you invested in has minus 20%, you've lost $200 just like that. If instead you take those $1,000 and divide them in, 10 months for instance, then you've only invested $100 for the first month, so you'd only take minus 20% on that, so that's $20. You'd rather lose $20 than $200, right? This is why DCA is king, especially during a bear market. So that's one reason, and the most obvious one, why dollar cost averaging is so effective. But there is also a second reason, and I think it is really important even though it's not as obvious, and that is removing any fear or concerns about prices going down in the short term. Let me explain. If we take our previous example where you've invested $1,000, and let's say that that's the only money that you can afford to invest, that's all you have. If you've done that, then you're gonna watch those charts every single day, if not every 10 minutes, because you wanna know how your money performs, and it might generate stress. You wanna know if you're earning money or not, and that's normal, that's human, we all do that. But if instead you are dollar cost averaging and you've only put $100 and you know you have $900 more sitting just waiting to be invested, and you just accept that you're gonna consistently invest and short-term dips don't matter, then you don't even have a reason to watch that chart anymore because you're going for the long term anyway. And trust me when I say this, even though your mental health doesn't directly correlate with the gains you're gonna make, it is extremely important to keep your sanity during those bear markets and not check those charts every 10 minutes. Now, we've just established how important dollar cost averaging is and the many upsides to it, but in order to do this, in order to keep investing, you do need more liquidity, more cash, and that brings us to our step number 2. Keep a consistent cash flow. So dollar cost averaging is key in order to set yourself up for success in a bear market. But in order to do that, you need fiat or real life currency. The bear market presents a massive investment opportunity, and to seize it, you need cash. How can you earn and save that cash? By working a second job? By skipping that midweek takeaway? Whatever it can be, try to make sure you constantly have some spare money to be able to invest every month, every week, or even every day if that's your strategy. And look, the amount doesn't matter here. This applies to everyone. Whether you have $100 to invest or tens of thousands of dollars, you need to make sure you don't skip your dollar cost averaging windows and stay consistent. And a way you can achieve this is with stable coins. So let's take our previous example. Let's say you already have the money that you want to invest. You have the $1,000. Instead of just buying crypto every month for $100, you're gonna buy $1,000 of stable coins and immediately make that first purchase of $100 of the crypto of your choice, and then keep doing that every month, whether it be through an automatic recurring buy or manually. But the point here is that your money is already in crypto, and all you have to do is just swap the USDT or BUSD or whatever stable coin tokens into the crypto of your choice. The reason why this is so important is that you want to catch all the uptrends of the crypto you're investing in. You can't know when it's going to go up, and if you miss a month, maybe that's going to be the month where it goes up by 40% after losing 30%, and that's surely going to affect your total gains by a lot. Step number 3, keep a cool head. When the market is volatile, it can be very tempting to just look at the few months you've invested and see it being down by 20-30% and just be like, okay, I'm done. I'm just going to withdraw this and register that loss. If that ever happens to you, I want you to do one thing, and that's zoom out. I know it is cliche once more, but it's for a very good reason again. There's no reason to panic here. Whenever you see a loss after like a short-term loss, you shouldn't even be affected by that. You shouldn't even think about it. It happens. You have to accept that and move on. Now, for obvious reasons, this is easier said than done, right? There's a big emotional factor that plays in when you're investing. The goal here is to make this as easy on yourself as you can. You do this by, as we've just seen, dollar cost averaging, making sure you invest the same amount of money every week, every month, but just make sure that it is an automatic process. Whether you manually do it or use a recurring by function, in your head, it has to be an automatic process. You can't be thinking like, oh, the last month it went minus 30%. I don't know if I want to invest now. It seems risky. You don't have to think about that. All you need to think about is making sure that periodically and consistently you invest the same amount every time. And you do not think about the repercussions. You do not try to day trade. You do not try to think about the outcome. That's not what you're doing. You're just making sure you get that money on that exchange, on that cold wallet, whatever, every X amount of time. Step number 4, avoid risky investments. We've talked about what's good practice, what you should do. Let's now talk about what you shouldn't do. I know that risk is relative, so allow me to give you a few examples. I'll talk about 2 different techniques that can usually be seen as risky investments, and I know they are very attractive for a lot of people. The first one is shorting. Shorting is an advanced technique that traders use to profit from downtrending prices. During bear markets, which are typically characterized by frequent price drops, shorting could be seen as a great idea. However, you'll find that a lot of experts will often advise against using this technique, especially if you're not a seasoned trader yourself. This is because opening a short position can expose you to a point where it can go to zero very quickly. When opening a long position, you can lose what you've invested, but the upside potential is literally limitless. You could go 10, 50, 100x on your position. When you open a short position, however, you can only earn a specific amount. So please do yourself a favor and don't think that just because we're in a bear market where there are downtrending prices, that it's a good idea to short crypto. Now, if you're an experienced day trader and you do that daily, please be my guest. I probably have nothing to teach you, but if that's not something you usually do, then don't think that just because we're in the bear market, it might be a good idea. I'm not saying it's never a good idea. People are making loads of money by shorting, but it is extremely advanced and you're competing against other very experienced traders when you do that. And the second technique I want to talk about is margin trading. If you've never heard about that, good for you, because it's something that a lot of people have gotten themselves into. It's very addictive. There's a reason why all centralized exchanges advertise it so much. They offer so much incentive, so many sign-up bonuses for it, and it is because they make so much money out of it. People lose so much money using margin trading. Now, again, I'm not saying it's necessarily a bad thing. If you're an experienced trader who's been margin trading for years, then more power to you. I'm not saying there's anything wrong with it. Just saying that if you're looking to make money in crypto and you're not necessarily a very experienced trader and just want to adopt the strategy we've been talking about, which is more of a hands-free approach that doesn't require day trading and thinking about your investment, then you should avoid margin trading like the plague. This is how whales make money off of Bitcoin or Ethereum, by day trading it all day, every day. They make sure to make the price fluctuate enough so that you are put out of your margin trade, and then that's how they manipulate prices. So you're never going to make money if you invest into margin trading without knowing exactly what you're doing. And the last thing I want to talk about before wrapping up this video, it's not necessarily a step to follow, but it's just something very important that I wanted to mention. During a bear market, what you have in abundance is time. You should use that time. This is the perfect moment for you to learn things, to teach yourself some skills that might be useful in the crypto space. Since we're in a bear market, there aren't as many opportunities as there would be in a bull market, during which you do have to be very alert and very active and available to invest and find the good opportunities. You don't have to do this during a bear market. You have more time, so use this time wisely. Do what you're doing right now. Watch videos to educate yourself, learn about the crypto market, the cycles, how everything works. When the next bull market hits, if you have followed the steps we've been through in this video, you will have had invested money every week or every month, and then that money will have caught all the growth that led up to that bull market. And that's it. If you got some value out of this video, please smash that like button for me and subscribe to my channel if you'd like to see more of this content. I post a video every Saturday, so thank you for watching, and I'll see you on the next one.